Well, hello there, everyone. We're going to let everyone join in with us, and then we will get this thing started once it kind of looks like we've basically brought in everybody that will be live with us today. So appreciate all of you being on for today's topic. Obviously, how to protect your 401k. It's a really big deal. I mean, you're out there, you're working, you're doing all the stuff, you're doing the day to day, and you're in your various jobs. And at some point, you might get to a place where you're like, I would like to not do this anymore and go do something different. And you want to be at a place where you can look at that and say, all right, now I've got some money saved up. I want to go do some special things with it. Or for most of us, Ben, it would be something like spending more time with family, being able to travel if you had kids, and do some stuff with them, being able to pass on money to your kids. And so for a lot of us, we have a lot of different things that we would like to do, but we would like to see our account grow as much as possible, and then be at a place where we could look back at that and say, okay, hey, I'm in a good spot here. And so part of doing that, Ben, is not just simply growing it, but protecting it. And so obviously when the markets are going up, we would anticipate, okay, we're making some money here, maybe making as much as we can. And then the difficulty is what happens when we experience something like we saw over the last 3 weeks when the markets all drop at least 10%. What does that look like for us? And that's not a topic that you hear um, many people speak about. And it's the topic that we are going to really dive into today. What are your options really when it comes to protecting your 401k? So we're looking forward to hearing Ben Russell present today. He's going to be our main presenter for this particular webinar, but we have several people that will be on as well, either answering questions in the background or later on in the presentation, answering some particular questions for you when we get to that point. So the rest of our team, I mentioned to you, Ben Russell, he's an integral part of AMPT, has been with us for really since the beginning of the program, had a lot to do with the program getting kicked off when it did. And then we have Jenny Taylor, and then she is going to be helping with some of you. So once you kind of go into the next process, you'll be working with some of these guys. And then we have David Verbrugen, who is helping out with a particular area of AMP, which we probably won't talk much about on this, but in their one-on-one conversations with you, if it applied to you, they could bring that up and talk to you there. But he's doing a fantastic job in control of a particular element of the AMP program. So we appreciate having David on board with us. And then we have Denny Foster. He's on with us as well today. You'll see him there a little bit at the end. He's one of our IARs that would be working directly with you. So those four are going to be your primary IAR person that you will interact with. And so you'll hear a little bit from each one of those. And then we've also got a couple of other people. We have Cassandra Russell, and then Debbie Calvert, and they work directly with us. And then I don't know that we have a couple more people, Diana Blood, and then Andrew Wilburn, and they will also be assisting you guys in this process. So you'll get a chance to talk with some of those, and all of those people just want to help make this as easy for you as possible, to try to help you navigate all of these things. And a lot of this stuff, it feels complex. And so we want to really try to help you understand that we're here to help you, and that we want to walk you through this process, and they'll be right there with you. So thank you for being on today. We look forward to hanging out with you here. If you are looking for the recording, it will be sent to you normally via email. So you'll get a chance to go back and either listen to it again, or if you happen to miss it live, you'll be able to catch it later. And then, of course, these guys will still be in touch with you if you're not live, to give you some insights as to what we can do with you going forward, just kind of gauging your interest in what that looks like. So thanks for being on with us today. I'm going to turn it over to Ben Russell and let him lead out the majority of the rest of what we're going to do here with you this time.
Awesome. Hey, thanks, Jeffrey. I appreciate that. And Jeffrey Nance is our executive director of the AMP program. So you've got the whole AMP team with us here today to talk about this really important and I think timely topic. We planned to do this webinar, about 6 weeks ago before we even knew any of this was going to happen. I think it's pretty timely for us to have this conversation. So I'm glad you're here today. I want to get started with some scripture, Jeffrey, because I think that really it underscores everything that we do. Look at what it says here in Proverbs. A prudent man foresees evil and hides himself, but the simple, they pass on and they're punished. All right, so we don't want to be the simpletons. We want to be people that have knowledge. We want to hide ourselves from evil. And as we go to the New Testament, we can see an interesting corollary to that. All scripture is given by the inspiration of God, and it's profitable. It gives us an advantage. It's profitable for what doctrine? And if we think about doctrine, well, that's just teaching. And what is it also good for? For reproof, which is proven standards that we can apply. For correction, correction is simply restoring or improving or giving us a better way in which to live or to conform our character. Why is it not going forward? There we go. For instructions in righteousness. So instructions in righteousness is about helping us to fix our mistakes, fix the things that need to be fixed. That the man of God, well, that is us, those who have a relationship through Jesus with the Spirit that lives inside us. Those are us, that we might be perfect, fitted with special aptitude or mature. Thoroughly furnished, that's a pretty cool way of saying completely ready unto all good works. And it doesn't matter what it applies to, Jeffrey. It's our business, our employment, the enterprises, our families, anything that we undertake to do. So when we think through this, what scripture does is it gives us guidelines that when we apply them, we have an advantage. And it teaches us with proven standards how to apply restoration or improving our character or fix mistakes to the children of God, because he's going to put us with special aptitude to be completely ready for anything that comes our way in every sphere of our life, including our finances. So when we look at knowledge, Proverbs 8:10 has a very interesting phrase that we should receive knowledge rather than choice gold. And not just any gold, not any 10-karat gold. We're talking the best gold. That knowledge is better than the best of the best gold. That's Proverbs 8:10. And when we look at Proverbs 24:4, it gives us a little bit more information. It's by knowledge, the things that we understand, that our chambers become filled with all kinds of pleasant and precious riches. Think through that. Knowledge becomes the way in which God works in and through us to be able to accomplish the things that we're looking for when it comes to our finances. Now, the reason why this is going to be important, Jeffrey and team and friends, if you do have some comments, the team in the background is there. That question at Q&A box is probably the best place for you to be able to respond. When you ask those questions, I've got several team members in the background that can help you with those questions. And we'll have a Q&A at the end as well for any questions that you might have that didn't get covered. But I do want to get into why this is important, Jeffrey, because the knowledge that we know as traders is that there are these things called bear markets. The markets don't always move up. So on average, a bear market, or something that has greater than a 20% decline, typically lasts on average for 14 months. Now, if it's going to go down for potentially over a year, you think maybe I might want to do something a little different than just buy and hold? Well, we think like traders, and we would say the answer is yes. The reason why is because, well, when there are things that happen in the economy that are out of the norm or cause even greater difficulty, like the financial crisis, in 2008, there was a financial crisis, Jeffrey. It was caused by a mortgage-backed security issue where what was supposed to be a really safe investment wasn't. And when it was discovered, it crashed the economy and portfolios dropped by over 50%. The S&P 500 went down over 50% in the mortgage-backed security financial crisis in 2008. That is a huge drop. And the reason why it's important is, well, because on average, the market goes up most of the time, friends. That's great. How much? Well, statistics are a little blended on this, but let's just take the conservative one. It's 6 to 8%. Let's just use 6%. On average, the markets go up 6% a year. With that 50% drop we saw in 2008, it would take you almost 10 years to recover. That is why we want to have some knowledge. We don't want to be simple. We don't want to be caught in these things. We want to be prepared. Now, let's zoom in on this a little bit, because what this chart kind of gives us is a little bit more of the reason why. Let me explain a little bit what's on this chart, because I think it's important. This is going back over time. This is a picture of the pricing action of the S&P 500. And what really gets interesting is to recognize that the big bad dips on this chart when it comes to price, these gray bars represent when was there an economic recession. And in an economic recession, equities don't do well. Why? Well, because nobody wants to buy an equity when the economy is not doing well. When the equity isn't looking to appreciate in value, don't own equities. Well, that's what happens in a recession. Equities typically decline in a recession. And you can see based on these gray bars that there were some pretty strong declines during those recessionary times. So every single one of these gray bars was a recession. Look at how the markets reacted to recessions. We had a very fast one in 2000, and we're beginning to hear more and more rumblings that we're likely going to move in to a recession with where we are right now in this economy. We have moved up so far, so fast, and even the secretaries associated with the Treasury. So Scott Bensent, who is Trump's current Secretary of the Treasury, has so much as said that a decline is going to be healthy for us, and we need to have a decline so that we can be prepared for the next phase of growth. Friends, that means we need to get prepared. So these bear markets through history have been interesting to study. We're going to go back and we're going to look at a chart in just a moment that shows a significant amount of time for the market. Most of us don't have that long of a memory. So I think it's important for us to be able to go back and look at history so that we can begin to make some correlations about what we might want to do. And some of these biggest declines have come because of some economic factors that we're going to discuss a little bit more, because we want you to know about them so that you can pay attention to maybe start to take action on your 401k before these things happen to your portfolio. So let's look at the bear markets through history. I think this is a fascinating study. This comes from LPL Research, and I love the way that this chart plays it out. Let me kind of give you the high level overview. Here is how much did the S&P decline for the year. So here's that 2008 decline, Jeffrey. We said 50%. We were being generous. It was almost 57%. Ouch. All right, so we had a recession. That's what that R means. So October of 2007 is when it started to decline. There was a recession. The market went down 56%. And the length of the bear market was 17 months. Now, at some point during that 17 months, I think you might have gotten a clue that you needed to do something different. And then this is the part that I think is really interesting, Jeffrey. It took 49 months to get back to even. And if you look back through history, friends, this is not just one time. This has happened many, many times since the 50s. And it's a great idea for us to be prepared to know what to do with our 401ks when we start to see some very strategic things happening. What sort of strategic things? Well, here is another interesting stat. The inverted yield curve becomes one of the most important factors of predicting a recession of almost all the other factors that we have. And we have been living in an inverted yield curve environment for a long time. So a recession is likely coming at some point based on this indicator. And what does a yield curve inversion mean? You get paid more money for a short-term debt than you would for a long-term debt. It makes no sense. And because it doesn't make sense, what actually happens is it starts to break parts of the economy, and it just takes a little while for the brokenness to catch up with the economy. But it almost always leads to a recession. Take a look at this quote down here. The 11 recessions since 1950, the S&P dropped an average of 20% during the recession and then recovers almost 40% in 18 months. These are some pretty strong indicators. Pretty strong indicators. All right, so here is another picture of what this looks like over time. When we go into the inverted yield curve is typically, look, it's during those same gray bars. What were those gray bars? Recessions. Why am I spending the time explaining this? Is because for you and I and people who are trying to protect our portfolios, one of the main things we're looking for, inverted yield curves and recessions. And when we start to see those environments happen, it's a great time to be prepared and know what to do to start to protect your funds. Now, I'm going to, in a few minutes, give you some examples of things that you can do, because many of you in your 401ks, you're pretty limited in what you can do. You can't roll it out, you can't roll it over. But what if there were some things that maybe you could do inside your 401k? Well, I'm going to give you some guidance about what to look for and how you can start to do some things inside your own 401k to get prepared if we see these things develop. That's where we're going today. So here's another picture of something I find interesting. These red parts of the curve of the S&P 500, they highlight the time frame in which the curves were inverted. All right, so we had an inverted yield curve, big decline. Inverted yield curve, oh, and then it took off. That's abnormal. Inverted yield curve, big decline. Inverted yield curve, big, oh, massive decline. All I'm trying to show you, friends, is the predictive nature of the inverted yield curve has historically been one of the best ways for us to know in advance it's time to get prudent. It's time to get ready because we might need to protect our funds. Does that make sense? Do you kind of see why I'm trying to describe this to you? Is that history tells us that if we want to be prudent with our funds, start getting cautious when you see signs of a recession. When the inverted yield curve is there, get cautious because that's normally the precursor of a recession. And we're there. We're seeing signs of that today. So this is a very timely webinar. And I hope that you're going to find some very interesting things as we transition to this next section. I'm going to talk about what can we do? Can we be prudent? Can we be prepared? Well, first things first is you got to talk to your benefits administrator. Log into your benefits portal. And what happens is you're going to see the choices that you have. Now, in a minute, I'm actually going to pull up a sample 401k. And I'm going to show you some of the things in a sample 401k that you can look for when you pull up your benefits portal. What we were looking for specifically is things that provide us with some downturn protection. So we're looking to determine in advance, what are those investment choices? There are things that look like fixed income, bonds, treasuries, money markets. It's those things that we're going to try to find inside our 401k so that when the time comes, we know in advance what our plan is to get protected. Here's an example. So this is a 401k program. All right, so I'm looking for things that say fixed income or treasury bills or bonds. I'm looking for those fixed income. All right, so I'm looking through my list here. Stock market. Most of these are what you are going to see in your 401k. Large cap equities. No, that's all stock market. Mid cap. Oh, that's all stock market. I don't see anything that meets the criteria you just told me about, Ben. You're right. You're right. And it's not normally until you get to the very end of the list that you begin to see these safer funds because they're almost always at the very bottom. So here we go. I can see there's emerging markets. Oh, bonds. I'm getting closer now. All right. So I can see that here's some bonds. And if I click on these, I can actually see what the bond funds are. Most of these are going to be corporate bonds. I'm looking for the government bonds and I'm looking for the money market. And if I don't have money market or corporate, the US bonds, things that are corporate bonds are probably the safest choice that I have inside my 401k. So what are you looking for? Look for money markets, look for government bonds, look for US bonds. Those are some of the safer parts of the portfolio that you can then allocate your funds into. So all we're suggesting is that when you start to see these signs come together in advance, know where you're going to go hide out during the storm. And if it takes 14 months to find the bottom of a bear market, it's a really good idea to consider not being in equities that are probably going to decline for the next 14 average months. Does
Hey,
that make
Ben,
sense? Yes, sir.
while we're here, is there anything they should know? If because for a lot of people, they might be looking at a screen like this, going, "I don't even know what all of this stuff means." Is there anything that they should be looking for that would help them kind of decide, like if I was looking at VBTLX under US bonds or VBILX, like how would I distinguish which one is which? Is there any particular thing, or should I do like, US government bonds? Is there any thought there as to what they would be looking for and how to even interpret what they might be seeing on a screen like this if they saw something similar under their options?
Yeah, Jeffrey, it's every 401k is going to have a different way of presenting this information, but they're all fairly similar. If you click on that ticker, that's a mutual fund in this case. And when you click on it, it's going to open another window to describe what's in that ticker. We're looking for short-term treasuries as sort of the safest place to be. Why? Because short-term treasuries don't have the inverted yield curve issues. If you go with the long bonds, sometimes those can't be as safe as the short-term treasuries. So the safest of the safe is going to be short-term treasuries and money markets. What is a money market? It's more of a guaranteed, it's not a CD, but it's kind of like a CD. They're going to say, this is the percent that you're going to get. And it's going to allow you to be able to have a place to go put the money. Again, not every 401k has these options. So what do you need to do? You need to log into your 401k. You need to look at your opportunities because there is no consistency. It's your company that determines what you can invest in. It's not like the government sets rules on it. Every company is going to be different.
Yeah, and what's interesting about that is when you kind of look at the returns, the numbers that they're showing you there. One of the things, Ben, that might seem obvious, but it's worth covering. When you look over there at the sector equities and you look at the 1 year return, some of those are pretty substantial. Um, and they might look at the money market and say that's only 5%. But you've got to remember, this is all about the risk return principle. So when you're dealing with equities, with stocks, you have a higher potential ROI, but they assume that you're taking a little bit more risk. Whereas a money market, you're going to get essentially a set return of sorts, but it's going to be at a lower amount because you are taking much less risk in the sense that it's, as you mentioned, almost a little bit more like a CD.
All right. So you don't necessarily want to go into equities, Jeffrey, if we know we're moving into a bearish environment, because those averages, well, the reason why they're averages is that they're over time. And if you decide to get into some of those equities right as you're going through a bear market, you're going to find yourself investing right at the time when those equities are likely going to decline. So this is more of a trader's mindset. We're simply trying to say, if we think we're going to have 14 months of decline, then let's go find the things in our 401k that don't have the same level of risk as equities do. That's it. That's the bottom line. So your benefits hotline is another great place for you to be able to get some help. If it's not really clear in your portal, we'll call the benefits hotline. Ask them, how do I navigate my portal? How do I find those safer funds within my account? I'm looking for the money markets. I'm looking for those treasury options. Where are they? Call them. That's what they're there for. It is their job to help you with that. I do want you to be prepared to do this before you have to. Nothing like trying to make decisions in a crisis, right? No, you want to do this in advance. And I'm going to suggest you probably want to do this pretty quickly because we are in some times in which you might have to start pulling these triggers sooner rather than later. Yeah, I'm not saying we're there. I'm saying the signs are beginning to rumble. And when we begin to see the rumble, that's when it's time to start getting prepared. So we're looking for those money markets. Why? Because there's signs on the charts, there's signs in the news that recession is potentially on the doorstep. And if we move into a recession, we're probably going to need to get defensive. So how do these 401k programs differ? Well, most of the time you've got different types of things that are built into your 401ks. Sometimes you can have pre-tax funds. Sometimes you can have post-tax funds in a Roth. But, Jeffrey, here's one other thing that I think is really interesting. I thought that this was kind of a fun little, does anybody know what 401k programs used to be called when they first announced these retirement programs? Does anybody know what they used to be called? Type in the chat window if you know. What did we used to call 401ks? When they first were announced by Congress. Nobody's going to take the bait. All right, I'll just tell you, they were called salary reduction programs. I think they had a marketing problem here. Think about it. Salary reduction programs. Well, in a way, there's some accuracy there. They're taking money out of your paycheck to put it in your retirement. So they are reducing your pay. But what I'm trying to do here is to call out that there's a bit of something missing in that marketing. The salary reduction programs are putting money away for you for your future. So they're reducing your salary. Avoid those bear market declines so that you're not getting a reduction on your reduction, friends. That's really what this is about. We don't want to see your salary reduction program, your retirement, see a reduction because of these bear markets. And that's why we really need you to be familiar with what's going on inside your benefits administrator portals. There's bullish versus bearish options. Normally, friends, I'm just being very upfront with you. Almost all 401k programs have great bullish options, but they have very few bearish options. That's why you got to get prepared in advance. When this market turmoil comes, those safer options is really where you want to try to hide out. And the other part that I want you to be cognizant of is that sometimes your 401ks limit the number of times you can make a change. Sometimes your 401ks will limit how long it takes for the change to take effect. These are things that you want to know in advance. So let me give you an example, Jeffrey.
Yeah.
Let's say that I'm in a 401k and I really don't know how long it's going to take for them to reallocate and change my funds. And I get the notice and the alerts. I'm looking at what's going on in the market. I'm like, great, I'm going to go change my portfolio, just to find out that it actually takes them 5 business days to do my allocation. I probably don't want to find that out in the heat of the moment.
Yeah.
All right, so everybody, you're going to have different rules and regulations, things inside your 401k. The other thing, Jeffrey, sometimes 401k programs will limit how many times you can make a change per year. I don't want to find that out in the heat of the moment either.
Yeah.
Let's say my 401k only lets me make a change once a month. Well, if I've already made a change that month and I go to make another change, I don't want to find that out the hard way. So know the rules of your program is really the bottom line. Because what do we want to do? We want to think like a trader. And what can we do? Well, let's apply some of our TRADEway skills and let's begin to think like a trader. And let's use the charts to start to help to drive us. And it's really going to be important. I don't know about you, Jeffrey, but if it's not on my calendar, it doesn't happen. What about you? If it's not on your calendar, do you remember it?
I mean, if I do it every week, but if it's something, that's out of the ordinary, no. In fact, Ben, I won't even sign up for like a subscription because they're like, oh, you can cancel. I'm like, I won't, and I'll end up getting charged for it forever. It's like, no, I got to put it on my calendar. I got to know it, or I'm just like, it's not, I just won't even do it. So yeah, I would forget.
Well, so those quarterly reviews is the concept, right? Put it on your calendar. And in that review with yourself, you want to ask, what's the current market tone? Are we bullish? Are we starting to get a little sideways? What's going on? But put it as a calendar invite so that you can begin to evaluate where is the market cycle. Now, TRADEway, we actually help you with some of this. It's something that we do every day in our market alerts, for example. So what can happen is we can begin to evaluate where are we in the market cycle as part of that quarterly review. And what I want you to see is here's a picture of the S&P 500 and it's put on the weekly chart. Now, this screenshot was from March 25th, Jeffrey, when I was doing this presentation. I told you that we weren't planning on doing this webinar for any particular reason. But 6 weeks ago, we decided that this was going to be the topical that we wanted to share with our friends because, if we needed to, we wanted everyone to be able to get defensive in their 401k. And man, it has been so timely. I love how the Lord works these things out. I mean, it's not like we planned this, but this is perfect timing. Why? Because the chart is actually beginning to show us some weakness. So here's what I want to do. This chart is on weekly. I want to be really clear. There is a very simplistic way to know when we start to get into trouble. When you see this gray line might be a little difficult to see. Let me see if I can find my laser pointer here. This grayish color line represents 20 weeks of pricing action. And when you start to see the market dip below 20 weeks of price action, that is a great time to start looking at getting defensive. And you can see the 20-week has often been a point at which the market will either pivot and go back up, or if we go further back in time, you'll see it will move down and continue to move down. Then the next one is the 50-week moving average, which, by the way, Jeffrey, is where we tag just this week. We tag the 50-week moving average. It could be getting close to the time where we really need to get defensive. In fact, most of us got defensive at the 20-week. If you're not yet defensive, if this 50-week moving average breaks, that is a great place to get defensive. Because if we break the 50, we're probably going much lower. All right, that's the cycle of the market. And it's just in a chart. There's not a lot of subjectivity to it. We're letting those moving averages, the math and pictures, help us to make the determination of what does the market tell us about where it is in its cycle. So those calendar reminders can be a really important thing. You know, just every quarter, just remind yourself on your calendar, go look at my 401k, make an evaluation. Where are we in the market cycle? Do I need to get defensive? And what are some of the warning signs? Now, Jeffrey, we also teach some interesting things. So these bull markets last 3 to 5 years. That's typical. A bull market, the market moving up 3 to 5 years. That's the norm, friends. You got great options in your 401ks for most of the bull market. But when we start seeing some telltale signs, something that we call a triple top. What is this? Well, the market moved up and failed. Not a big deal. It's kind of normal. But when it moves up to the same area and fails twice, well, that's a 2x top. That is a double top, or what we call an M-based pattern. And when we begin to see triple tops on the weekly charts, that's when we're getting a much stronger indication that the market is likely moving lower. The reason why I think this chart is so powerful for where we are right now, we are here in March of 2025. In March of 2025, we're beginning to see that we might have double. And if the market does, in fact, rally back up and then fail again, we could be looking at a triple top. A triple top with a recession, with an inverted yield curve. The dominoes are starting to stack pretty negatively if we start to see this pricing action. It'd be a great time for us to be prepared. All right, so what can we do to help? Well, let's say that you have the capability of rolling over some of your funds. That is an option. You can call your benefits administrator. You can ask them, hey, can I roll over any of my funds? And if the answer is yes, well, AMPT can help you with that. Our licensed investment advisory reps, we can help you with getting those funds moved over to Interactive Brokers. And that's when we can press the buttons for you. And when you call them, just ask that simple question. How much can I roll over to a self-managed IRA? And if they're going to allow you to do that rollover, then we can help you with it. And then we begin to do the management, and we'll help build a portfolio with you. And that's one of the things that we're going to offer at the end of today's session. If you'd like a private consultation with one of our investment advisory reps, we'd be happy to talk through our program with you. Why is this important? Well, this is our founder, David Mitchell. And one of the things that he says that got my attention, if you don't know, I was a student before I was a part of TRADEway. And one of the things that really got my attention is this quote that's on the screen right now. Bear markets happen every 3.5 to 5 years. And what David says that got my attention, I'll just read it for you. I've always been amazed by Wall Street's universal habit of leaving people's money in the stock market all the way to the bottom of a bear market crash. They happen on average every 3.5 to 5 years. Wow. Wow. All right. So if they happen that frequently, do you think maybe I want to get prepared for that? Yeah. So it's really interesting that we've got an opportunity to be able to talk through what this can look like for you. Now, we are active money managers. Typically, your 401ks are very passive. Your advisors, when you schedule a call with them, you can see what the fees and the structures are for our AMP program. But what I'd like to do now is just kind of briefly, Jeffrey, I'd like to talk about how it is that we help to be able to create some portfolios. Do you think it might be helpful if we kind of share with our friends how we build portfolios at AMPT and maybe give them Some of that because it can help them as they're managing their 401ks too, right?
Yeah, I think there's some definitely beneficial things to kind of walking through that, Ben.
So here, let's just walk through it quickly, Jeffrey. So we have two parts of our perspective. Remember, our company's name is what? TRADEway. So we think in terms of short-term and long-term funds as we build a portfolio. And the reason why that's important is almost all other advisors, they're not going to do any active trading, and they're going to be more of a buy and hold when it comes time for them to allocate. They buy it and they don't really change it. They just expect the market to always go up. So when we talk long term, we're looking at things that last for weeks to months at a time. So let's go look at what we would do. So we'll blend as a part of your conversation. You get to go build a portfolio with your advisor if you wanted to move forward and have a conversation. We would look at having a conversation. What does it look like for us to build a portfolio for you? We typically start with an 80-20 model, where we put 80% of funds into longer term, safer, more diversified assets, things that last for weeks to months at a time based on the market cycle. And then we'll take a portion of funds and we'll put it into a short-term trading account. We call that the up account. In the up account, we have the capability of trading. Now, this isn't as diversified. It is more aggressive, but the opportunities are there for the potential to make higher returns. So safer returns, more diversified, the potential for higher returns, and that's how we blend and help to create a portfolio. Again, you can talk with the investment advisor when you schedule your call to figure out what might be best for you and your family with where you are. So what's the advantage of AIM, that long-term 80% money? Well, our first goal is to protect it. Think through that for just a moment. If we know that bear markets have a tendency to be at least 14 months and 34% decline, sometimes 50 or greater, wouldn't it make sense to have the first goal as protecting it? And we're going to shift the portfolio mixes based on what's actually going on during these economic cycles. And we're going to look to preserve that cash through those bearish cycles. Currently, we are only about 18% invested on our most aggressive portfolio in the long term. And that 18% is invested in stuff that's really hanging out pretty well in this environment. But we're not in things like technology. We're not in things that have a greater tendency to be volatile in times like this. Does your investment advisor do that? Does your 401k do that? Usually the answer is no. Now, long-term is designed to grow a little bit more safely and slowly because stocks typically move up slowly over time. But we're going to ride the bumps, but we're not going to be in all the way to the bottom of the bear. Now, Jeffrey, this is a pretty big, important part for us, right? We want to protect those funds because maybe this isn't obvious, but why is it important to protect the funds during the bear? Because what happens after the bear, Jeffrey?
Yeah, I mean, generally speaking, Ben, you historically tend to get what we call a bull market, and that's one of those areas where, generally speaking, now the time frames you referenced, where there were times, 2000, 2008, where it took almost 4 years to recover. Well, that's a pretty big deal, especially when you had 50% drops. Our recent drops haven't been anywhere close to that. Even COVID was about, I think, 36% or so, but it recovered very quickly. So a lot of people have navigated these recent bear markets. 2022 was a bear market. It lasted a little bit longer than the previous ones, but wasn't very deep overall. So we've had these really like kind of quick moves back up. And so most people haven't really thought much about, well, I didn't feel like I lost much. So it hasn't had the feel of a 2000 or 2008 because we haven't had this long exaggerated move down where the S&P dropped, so much. It was kind of fascinating to look at some of those numbers and realize the S&P was at, 400 or 800 or 1,000 or 2,000. So now, I mean, it's not uncommon for us to see the market move 100 points in a day. And at one point, that would have been a 25% drop, which is pretty wild. So, as we kind of navigate this, we've kind of been a little cautious here, just knowing that, maybe we're close to a top, maybe we're not, but we have the ability to be nimble, but we have been pretty conservative for for a while now. And again, a part of that is that we really hone in on the protect your assets. And so it's a big part of what we're trying to do. And when you think about that over time, um, I mean, just imagine you can put numbers in, which is 100,000, and you lost 10%, but you did have a bear market, let's just say every 3 years, Ben. So that'd be 10%, then it would recover, but it takes, 11% to get back to where you were. Then it's 10%, then it's 11%, it's 10%, 11%. So, back in the day, 2000, when you lost 50%, it took 100% to get back to even.
Mm.
So we're really working hard because you don't know when it starts. Well, how far is it going to go? How long is it going to last? Recently the Fed has played a part. They're going to have some kind of big news here in about 20 minutes, actually, that could impact the market here. But they've been certainly more uh, willing to intervene to keep some of that stuff from happening. But we haven't had some of those major economic factors that have really reared. They not be this one, but it may be the next one, or it may be 5 years down the road, or 10, or whatever. But we do want you to be prepared that even losing as little as possible puts you ahead whenever the market does recover in a new bull market. You're going to tend to see stocks move up 50 to 100% or more. And that's a great opportunity to get in, but you don't want to be like recovering during that stretch. You want to be making money. So the less you lose, the more you're actually going to be making. And when you compound that over time, it becomes a really big deal. So, that's why protecting your money is a big thing, because, depending on how much it drops, now you're not just trying to catch up, you're actually getting ahead faster. And so that's why, we're so concerned about protecting what you already have.
Jeffrey, the thing you said, I want to underscore it. It's if you protect through the bear, it's the other side when that bull market happens where everybody else is getting back to even with the massive increases that it takes for them to get back to even. Imagine having a majority of your portfolio still intact going through the bear. And now you've got a greater cost basis because you didn't take those same hits. And the capabilities of trying to get those going back to even that your neighbor's doing, apply that to a larger portfolio balance. That's what David Mitchell would call the potential for creating generational wealth. And if you can avoid those throughout your lifetime and throughout your family's lifetime, that can make a significant difference in your family's financial future. And that's really what we want to talk about here. It's being protectionary when it makes sense can really, really, really start put the odds on your favor. All right, so what we do, Jeffrey, is we've got bullish portfolios with different risk tolerances. And this is just a general overview. You can talk more about this with your advisor. But how much do you want us to put in the market during bullish times? We'll build a bullish portfolio. And then we're going to have another type of portfolio that we use. It's called the squirrely portfolio. And actually, Jeffrey, right now we're in the squirrely portfolio.
Yeah.
We're not clear what this market's doing. So we've raised an awful lot of fixed income. We've got cash on hand, which is really good because at Interactive Brokers, they're paying us almost 4% on most of the accounts that come over. You're going to have the ability to get access to 4%. I think it's 3.97. Now that's on a balance that's above $10,000, but think through that. That's a near CD-like rate when we're in cash. That's awesome. All right, so now let's think through this cycle. Let's say that this is nothing, Jeffrey. We bounce from the 50-week and we keep moving up. Well, we'll just go back into the bullish. That's what's going to happen. We'll go back into the bullish portfolio. All right, so we'll go into bullish. We dip again and we start, we're starting to see that triple top, Jeffrey. All right, let's get squirrely here. Let's get defensive. And then what happens often is after that, like bull, squirrel, well, then we typically do see a bearish environment and we have a bearish portfolio. And if you're going to be aggressive with us or growth in your long-term funds, we can do something called an inverse ETF. And what's crazy about an inverse ETF is it kind of acts a little bit like a put. It makes money when the market declines. So imagine having part of your portfolio, if you're growth or aggressive, where part of your money is actually involved in an instrument that is increasing in value as the market drops. Most other advisors will not leverage those. And we want to think like traders. All right, so let's keep going here. That short-term trading account is also a pretty big part of what's different about what we do at TRADEway. Now, where the long term was weeks to months at a time, these are days to weeks at a time. These are very short-term trades. And our goal is to be able to take educated risks with higher probability trades. And on accounts that are above 25,000, when the opportunities present themselves where it matches our criteria, we can do limited options inside these accounts with more than $25,000. And what's our goal? We're going to try to grow the funds faster by investing in specific stocks that have greater potential to grow than maybe the overall market, or these safer, more diversified instruments that we use in the long-term account. And not all trades work. If you've been with TRADEway for any period of time, you know that to be true. Not all trades work. We've got stop outs based on the charts and a plan, and the goals are to shift more quickly and be more reactive with the market. So these ultra portfolios, there's 3 different traders that have a third of the portfolio. Each trade is documented. There is an opportunity to be able to hold the positions, add to some more, pyramid in, pyramid out. And because stocks will often make very quick moves, you'll see that we typically take profits pretty quickly. Trying to control the trade sizes, scaling in and scaling out, like what we teach in our programs. What does this come down to? When you meet with your advisor, we're going to talk about how can we start to build a portfolio for you. For the busy investor, we can build a long-term portfolio. We'll go between bull and squirrel and bear inside your AIM money. And then depending on how much you want to bring over to our aggressive ultra portfolio, the short-term trading, we can actively trade those funds for you there as well. So what does this really come down to, Jeffrey, is that if you can move money from your 401k, or if you have funds that you want our help with managing outside your 401k, maybe you've got a stranded 401k at an old employer, right? You haven't thought about it in years and it's just sitting there. This would be a great time to consider maybe getting defensive with those funds, and let us help you to consolidate and clean that up, and let our team be a part of helping you to make that happen. So AMP comes down to this. It's a biblical approach. It's a biblical approach to investing. You're going to get support from a team that doesn't just think about the bulls. We also think about the bears. We're going to help you with diversification. We have access to some of the best rates in the market when it comes for us to get defensive. And you got an entire team of people behind you to help make this happen. So Jeffrey, as we transition to this next part, we're going to be talking to some of the advisors that might be helping our friends if they decide to move forward. So who do we have that's going to be helping us?
Yeah, so Jenny Taylor is one that they might hear from, Denny Foster, David Verbruggen, all of these people, and Ben Russell, who has been leading out today. They would have the opportunity to meet with these folks in a one-on-one type environment to kind of figure out what the next step looks like, and what they can do. Because we want to be clear, Ben, whether or not you're in a spot to move over with us, or not, we want to help you. We want this webinar to help you, and hopefully we pointed out a few things that maybe you can do or think through, or at least see us as a resource. Because for a lot of people, as long as they're still employed at their current job, they're going to need to stay where they are. But we still want you to be in a spot where you're like, all right, what can I do with this and still apply these principles? So we want to help you. And then if you feel like, hey, I'm one of those people that just has some funds and I could move them over, I would be interested in that. We want to hear from you. So we've got a poll here, and we just want you guys to work through this, and then we'll be assigning those that respond. You'll be hearing from one of these 4 people here, and they'll be walking through a series of things with you to kind of help you understand what's in your best interest. What do you want to do? What's your risk tolerance? Helping you with the account. And if you decide you're going to transfer over, how does that work? So we've got a great team that's going to work with you to do all of those things, Ben, and we're going to introduce some of those guys here in just a bit. But right now, we really want you just to kind of answer, and some of you guys are already doing that, just and answer our little poll question here, and that will help us know what to do from here.
Thanks, Jeffrey. And I think what's amazing about this poll is the technology that's built behind it. You see, what's going to happen is that if you answer this poll, we know that you want us to contact you. So we'll send you an email, and we'll be able to say, hey, one of the advisor who's ever assigned to you is going to reach out to you. And it's going to have a scheduling link where you can click on that link and look at their calendar, and you can book a meeting for a time that's convenient for you. We can then jump on a Zoom session just like this and have an active conversation about the questions you have, your portfolio, and how we can look at trying to help get prepared for what we think might be coming. So this is a great opportunity, friends, for you to be able to meet directly with an advisor and get your questions answered. All you got to do, just click on the poll question, and that's how you let us know you'd like for us to schedule a meeting with you. I think it's going to be interesting here. There's a few leading questions that I've already seen in the chat. Jeffrey, let's transition to a couple of like the most common asked questions. Hey, Denny, are you out there, Denny Foster?
I am, Ben. How are you?
Hey, Denny, thanks for being on today. I know you're going to be helping a lot of our friends too. Are there any kinds of restrictions, or what kind of accounts can we help people with?
Yeah, pretty much every type of account. We do individual accounts, joint accounts. We can do 401ks that are rolled over to IRAs or Roth IRAs, corporate accounts for your LLC, and other entities. I mean, with IBRK, IBKR, we are really flexible in what we are able to help our students with.
It's what you just said is perfect. The flexibility of IBKR. And there's one specific area that I'd love to call out because this typically surprises people. We can even do your LLC accounts, those corporate accounts or those business accounts. Many of you are like, hey, I just want some activity for my business, but I don't want to spend the $120 a month on market data. What could I do? Well, why don't you let us pay the market data? We'll pay the market data and we'll trade and we'll invest the account. And then that way you don't have to. That's one very powerful way that a lot of clients will take advantage of the AMP portfolio services. So it doesn't just have to be retirement accounts. It can be an individual account. It can be a savings account that you want a little bit better return capabilities on. We have a lot of flexibility to help you there. So it's not just retirement that we help with. Thank you, Denny. I appreciate that, sir. David Verbugen, you're on as well. Are you out there, David?
I am here, Ben. How are you doing today?
So it's really good to be able to hear you, sir. I don't get to work with you much anymore, so it's pretty cool to see you on this side. How you doing?
Doing well. Doing well. Thank you, Ben.
So, David, one thing that I know is that this can be kind of a complicated. Are we just gonna let our friends figure it out for themselves?
Yep, exactly. We're just going to throw them to the wolves. You guys, you're on your own. Figure it out. No, Ben, obviously, we're going to help you guys. This can be a complicated process. These forms and everything, application that you go through with interactive brokers, it can look confusing and intimidating at first. This is why we want to walk through every single step of the process with you. Every button click, every field that needs to be populated, we're going to be there with you so it's done the right way the first time. And Ben, I find that this really helps people kind of take the pressure off, instead of having to figure out and fear that they pushed the wrong button. No, we're there with you. We're going to walk you through the whole process of setting up the application and doing the funding process. So we're there every single step of the way for you to help you out so it's done the right way the first time.
David, it's such an important part here is, if you've ever tried to open up one of these brokerage accounts, it's like it's a foreign language. I mean,
Yep.
They're asking questions. You're like, what does that even mean? It's English,
Yep.
but it doesn't translate in my head.
What is per stirpies? We'll walk you through it.
So our team, we've got a grouping of people. We call them client engagement managers, CEM, client engagement managers. And what they do is they're here to help you to get those accounts started. They jump on a Zoom session. They help you to answer questions like per stirpies that David just mentioned. That's all about who's your beneficiaries, all those things. They explain it for you so you don't have to sit there and scratch your head and trying to figure out what that is and go do a Google search. So we're going to help you with that. Now, the other thing that I really think is really powerful here is that you also get our team communicating with you on a frequent basis. You see, with AMPT, we're not like other advisors. We're going to tell you what we think on at least a monthly basis. You get an update from us. We tell you what we're doing with the funds and why we're doing what we're doing with the funds. And we don't just rebalance once or twice a year. We are very active in how we manage the portfolio. And when we see something in the market, we start to make the change. And we're not going to be that buy and hold money manager that many of you are used to. This isn't like we talk with you once a year and rebalance your portfolio. No, we are very active in that rebalancing. All right, so let's see here. let me take a quick look. If you haven't yet answered that poll, you still have an opportunity. It's on the screen. All you got to do is click on the button that applies to you. If you're an existing AMP client, that's the one at the top. If you're already working with one of our advisors, would you let us know that so we can just make sure to pair you up with that advisor? That would be really helpful for us on this side. Okay, well, it looks like the question board is pretty clear. Jeffrey, are those in the background? Is there any other questions that I need to cover?
No, everybody is answering those questions that have come in, Ben, and we've had some good questions. So one of the things that we would say is feel free to reach out. If you do have a question, we really do want to help you. So let us know how we can do that. And, we appreciate you taking the time to be with us today. Thanks for all the IARs that have been knocking out those questions in the background. Thank you for filling out the poll. So somebody will be getting in touch with you soon. And we will be following up with you and then walking you through the process. So we just really appreciate Ben leading us out today and walking through what some of this looks like, giving us a little, history lesson, if you will, on what some of this has looked like in the past. And right now, Ben, just earlier, what was it, last week, we had met what we call a correction, which is a 10% drop in all the markets. So the S&P 500, the NASDAQ, the Dow, I mean, all of those essentially had dropped over 10% in a 3-week stretch. So you can imagine, what that kind of felt like. And so in order to even get into a bear market, we would have to double what's already happened. So just kind of be aware of that, guys, whether you're doing something with us moving forward or not. Like, we care about you and want you to do well. And so part of what we're trying to do is just offer educational opportunities to you. And that's what this was about today. So appreciate you being on and giving us the opportunity to try to help you out and answer some of your questions today. And for some of you guys, you'll be joining us, and we really value those that have entrusted their funds with us, and we want to be very great stewards of that. So protecting it and also helping it grow. And there have been some questions there. I think Jenny's knocking one out now about gold. Obviously, gold has been on quite the tear recently, Ben. And what I would say to that is, some funds might be available, but those are fairly specific. So you would have to go searching out something if you wanted to hold physical gold.
We can do gold in a different way. There are actually ETFs or exchange traded funds that are tied to the price of gold. And we do have that as part of our portfolio, Jeffrey. So
that's correct.
We do gold in our portfolio. Now, it's not physical gold, but there are opportunities for us to take advantage of precious metals and their pricing inside of the AMP portfolio mix.
So it's a little different there. So if you're looking for physical, that's going to be a little different. You will have to be a little limited, but there are opportunities for that, Ben. But we still have our own opportunities, as you mentioned, to take advantage of that as well.
Jeffrey, I think it's really good just to be able to, this is timely because we're at the point where this market is trying to figure out what it wants to do. And the very things that I've talked about in this webinar could in fact become our future. I'd love to be able to be a part of kind of pushing you a little bit. Can I gently do that as a coach? Can I push you to don't ignore this? Go find out from your benefits administrator what you can do, because you don't want to try to figure it out in a crisis. And with the things that are happening right now, there's enough that's happening that if we don't start to see some improvement in the economic conditions, there's some pretty strong likelihood that we will be moving into a recession. And that's when you want to make sure that you know how to get prepared. So thanks for being here today. If you're watching this recording, by the way, this is going to be posted out on YouTube TV. So youtube.com/TRADEway is going to have this replay on it. And you're potentially watching this after the fact. You can still schedule an appointment with us as well. Just go out to our website, TRADEway.com/AMPT, AMPT. You can ask for an advisor to contact you, send you a scheduling link, and we'd be happy to help you as well. Thanks for being on with us. Thanks for the team for making this happen. Appreciate you guys. Have a great one. Goodbye.